Have you ever stared at your charts and thought, this is just pure chaos? What if I told you it's not random at all? That there's actually a hidden pattern, a master cycle that's pulling the strings behind every single move the market makes? Well, today we're going to pull back that curtain and decode it.
But first, we have to tackle the big, frustrating question, right? Why do so many traders fail? You know the feeling. You see a move, you jump in, and then you just watch in pain as the market whips right back around, takes out your stop loss, and then goes in the direction you originally thought. It literally feels like the market is hunting you personally.
But here's the thing. That feeling, it isn't just paranoia. The truth is, the market isn't random. It's an engineered system, and it follows a script, a repeatable cycle that's designed for a very, very specific purpose. And this right here perfectly shows the two sides of the coin. You've got the retail mindset, which sees chaos and trades on pure emotion, that fear of missing out. But then you have the institutional mindset. They don't see chaos, they see an engineered process. They're not reacting to the market, they're creating it. And understanding their playbook is everything.
So let's be super clear. The reason most traders fail isn't because of a bad indicator or the wrong strategy. It's because they don't understand the game that's being played. The market is built on a three-phase cycle that's literally designed to move money from the uninformed to the informed.
So what is this cycle? Well, the whole thing boils down to these three phases. Contraction, where the energy gets stored up, expansion, where the trap gets set, and finally, trend, which is where the real move happens. Let's break each one down.
Okay, first up, phase 1, contraction. The best way to think about this is like the market is coiling a giant spring or charging a massive battery. On the surface, it looks kind of boring, right? Just sideways action. But underneath that quiet surface, the big players are secretly, quietly building their massive position.
So during this phase, you'll see volatility just dry up. The price gets squeezed into this really tight box. Now, this isn't just random chop. It's a deliberate period where huge potential energy is being stored, getting ready for a really violent move later on.
And here's how you can actually spot it. On your charts, you're going to see the price making a higher low and a lower high at the same time, basically squeezing it into a triangle or a box. For the institutions, this low volume, low volatility environment is absolutely perfect for them to slowly build a huge position without tipping their hand to the rest of the market. Now, if you draw a line right through the middle of this contraction box, you get what we call a value line. Think of this line as the market maker's home base, their ultimate point of control. The entire cycle, everything that's about to happen, is going to revolve around this level. Their game plan is simple: buy below it and sell above it.
Okay, next up is phase 2, expansion. And let me tell you, this is by far the most dangerous part of the whole cycle. I like to call it the Judas swing because it is designed to betray you. It's nothing more than a perfectly engineered trap.
So this phase kicks off with a huge, explosive breakout from that box we were just talking about. Everyone sees this giant candle, FOMO kicks in, and they all pile in, thinking, this is it, I've caught the big one. And that is exactly what the market makers want you to think.
This false move, that's the Judas swing. Its one and only job is to harvest liquidity. And when we say liquidity, all we mean is a giant pool of buy or sell orders. The big players need these orders to fill their own massive positions. And your stop loss? Oh yeah, that's prime liquidity for them.
So here's how the trap is sprung. First, they induce you with that big breakout. It creates FOMO, sucks everyone in. Second, as all the retail traders are frantically buying, they're actually providing the perfect liquidity for the institutions to do the exact opposite, to fill their massive sell orders. And once those orders are filled, bam, they slam the price in the other direction, leaving every single breakout trader trapped on the wrong side of the market.
And that sudden, violent reversal, that's what leads us to phase 3, the trend. This is the payoff. This is the real move that the institutions were planning all along. And this is where the patient professional trader finally gets to work.
So let's compare these two, side by side. The trap in phase 2 is erratic, it's chaotic, it's designed to create fakeouts and cause maximum confusion. But the payoff in phase 3 is clean, it's directional, it's sustained. Its purpose isn't to confuse you, it's just to get price from point A to point B as efficiently as possible.
So you might be asking, how do I know the trap is over and the real move is started? Well, we wait for confirmation. The key signal we're looking for is called a break of structure, or BOS. This is when price smashes through a previous swing high or low in the new direction. That confirms the manipulation is done, and the institutional wind is now at our back.
And this, right here, this is the discipline that separates the pros from the 90%. They do not chase that phase 2 breakout. They sit on their hands. They patiently wait for the trap to spring, they wait for that break of structure, and then they look for an entry on a small pullback during the clean phase 3 trend.
You see, understanding this cycle requires a total shift in your mindset. You have to stop thinking like prey, just reacting to every little price flick, and start thinking like a predator, understanding the hunt before it even begins.
So, your new rulebook is actually pretty simple. Rule number 1, stay out of the phase 1 box. That's not for you. Rule number 2, never, ever chase the phase 2 breakout trap. That's just asking for trouble. And rule number 3, you wait. You wait for the trap to be sprung and confirmed, and you only execute in phase 3. That is your strike zone. At the end of the day, this entire process is designed to take liquidity from retail traders to fuel institutional moves. So the final question you have to ask yourself is this. In this big market ecosystem, are you the fuel or are you the one driving the car? Are you the liquidity or are you the predator?